I'm Rebecca Cullen, and we launched Grid. Actually, you were on one via Zoom, Eric. And so we launched Grid here in Charlotte in 2000. Hey, welcome. Hi, come on in. You're right on time. We launched Grid Charlotte back in May, I think. I think May was our launch-ish. Come on in. Hi. And so we launched in May, and we've had like really good response about this. We've had private money lenders, we've had financial advisors, we've had construction folks, like we've had all of the subject matter experts. And the whole point of Grid is to network and learn about each other in the industry, but also find deals and find ways that we can actually work together. So it's my favorite part about it. And Grid is a global group. So Eric was just asking if it's on the Facebook page. Like literally go join that Facebook page, because there are deals to be found in there. There are conversations around what people are up to. It's called the Grid Investor Community, I think it's called. But it's just different community leaders, and there's power in numbers, right? So today we brought y'all some subject matter experts, and I'm gonna start with you. Jeff, who are you? What do you do?
All right, sure. Well,
Well, we're not doing a presentation yet, so literally just who you are and what you do.
I recently joined Liberty Mutual. Was with Keller Williams for a couple of years, doing auto, home, and life insurance. And I have been licensed since 2008. And I met with Rebecca recently to talk about basically the advantages of life insurance and how it could benefit people in our world.
Yeah, self-employed folks. Jeff and I also went to high school together and college together, and then real estate together, all the things. And then you.
So my name's Eric, guys. Our company is called Cullen Cities. I'll give you a quick 30-second blurb about it. We were founded in Philadelphia in 2018 by two investors that found it harder and harder to find good deals, as we're all experiencing right now pretty much, and just started lending out their money out of necessity to want to be a part of real estate, and they couldn't find the deals themselves. They thought there needed to be a better lending experience out there. There was some shortfalls working with banks and some pain points working with hard money. So kind of just grew this institutional lending platform into what it is now. So it started as Cullen Philly. I think the second loan they ever gave out was in New Jersey, and it's like, crap, we have to change the name. We can't just be Cullen Philly anymore. So we got rebranded to Cullen Cities, and now we've got kind of 1- and 2-man teams like myself across the country. But the home office stays in Philadelphia, where all the processing and servicing and origination happens at. So that's our story.
Awesome. So I want to open this up to y'all as well, because again, power in numbers, power in the networking. There's like, I know everyone, but y'all don't know each other. So if you wouldn't mind starting, sure. And maybe like if you're up to something right now, like project-wise.
Okay. I'm Carlin. I've had my real estate license for a year and a quarter. I have closed 14 deals, all buyers and sellers. But one of the original reasons that I got my real estate license was to be able to become a real estate investor and make passive income alongside creating a career. My long-term plan is only to be an active selling real estate agent for 10 years. And then I would like to travel and only have passive income from there. So I'm here to kind of network and learn how to make that possible. I'm not really, I guess, up to any projects, but my significant other is in the wholesaling real estate world. He works with one of the bigger firms in Charlotte. I don't know if you guys have heard of New Western Acquisitions.
He sent me an offer.
Yeah, he did. He was like, do you know this Rebecca lady? I was like, yep, I sure know that Rebecca lady.
I was like, add a couple zeros to that offer, but.
He sent Shannon Cole a few offers too.
Yeah.
But anytime that I see any like off market, office exclusive opportunities, or just being around our office, sometimes people will say, you know, what do you think about this thing? Or what do you think about that? And just having some of those conversations around, well, is that a property that's smart to put on the market and kind of make the seller super vulnerable? Or can we take that to off market investor type buyers and make a win-win situation happen? So I'm definitely an out of the box thinker, and definitely looking to be an investor eventually myself.
Yeah. My name is Margot. Thanks for having me today. You're so excited. So I am brand new to real estate. I got my license in September this year. I joined Cullen Connected. I'm on the Carolina Loves team with these two amazing people. And my long-term goal is very similar to Carlin's. My husband and I want to do real estate investing eventually. We just got married last year, so we're just trying to figure out that. And then we'll eventually get into, you know, this deeper endeavor of investing. So yeah, so I'm happy to be here and excited to learn. Oh yeah, he's a handyman. He can literally do anything.
Awesome.
Let me know.
He wants to get into general contracting.
Yeah, he's
Good.
working on that now. So
Great.
I guess that's kind of a project.
Yeah. It is. Speaking of.
I'm Julie, network marketing not too long ago. I am Joe for a year. Me and my husband, we're the duo team. So we've been doing general contracting work for several years, but decided to take it more serious. COVID was kind of like the kickoff for us, so we're doing pretty good. And as we're doing a lot of flips for investors, we're kind of like, this is pretty interesting. So I've been trying to, you know, get that into the industry, so as much knowledge, network, meet new people, and yeah, looking for opportunities and whatever. So if you need counseling or whatever, I'm actually helping somebody now with the license. Okay. So I have a good spot.
Okay, look at that. Yay.
Thanks for sharing. I'm so glad you're here.
Thank you.
My name is Vince Carlson. Got my real estate license in past July,
Okay.
August. So brand spanking new. Margo, I've been married 20 years and I'm still at that stage trying to figure that out. So that's always going to happen. So so recently moved out from California. I have a father-in-law that we follow them out because they're Asian. But when he was in California, he had money. He works high up in pharmaceuticals, and so he had money. His brother was a contractor, and they flipped all the time. And they did very well. So now he's moved up here. He's pulled all his money out of the stock market because it's been just pissing him off. And so then he called me and said, "Hey, I need to start flipping his houses. You're in real estate, start finding some stuff to flip." A little different. He doesn't have a contractor in his pocket like he did before, so he can't do it as cheap. And he used to do a lot of labor because he also worked with his brother's contractor. So a little different. So now I'm kind of like, okay, well, I need to really get in and see what the deals are. Just look at long terms, short terms, and just start figuring it out.
Yeah.
So that's what I'm here.
Well, Eric might have some suggestions for financing.
Hi, I'm Jeff Jones. I've been here since 2017.
Great.
Real estate, a little bit of everything. Mechanic, truck driver, warehouse. I got tired of all that, so I was going to do something in the future. So that's when I started real estate. Getting older and don't want to work too hard in my old years.
Yeah.
And, you know, trying to find a little passive income type stuff too.
Awesome. You're in the right room. Well, cool. So today's grid is about being the bank and how to fund and get creative. And so I'm going to start with you, Eric, if that's cool.
Yeah.
How can you work with that?
Yeah, so I'll tell them a quick story about when I called you. So we're, if you had to put us into a box, it would be a hard money lender. Are you guys all familiar kind of with how that works and everything? Basically, your loan is backed by the collateral of the property. rather than your personal assets. So we're not asking for tax returns, W-2s, or anything like that. It's basically if you went into foreclosure or anything, a hard asset is the collateral to be taken back by the bank. So that's kind of the term hard money and where we fit in. We try to, there's sometimes, and some people have great relationships with hard money lenders, there can be kind of a negative stigma around the relationship and trust and things like that. So we try to really put a premium on partnerships and doing things like this and meeting our borrowers and having someone that you don't just call me when you need a loan. Maybe it's, hey, can you take a second set of eyes on underwriting this deal? Or, hey, I found this comp in this neighborhood, you think it makes sense? So that's why moving down here was important for me to be able to do things like that, because covering territory remotely from Philadelphia, you don't get the genuineness and a real feel for the market and driving around. So we also have some aspects of some banking from an institutional standpoint when it comes to like the capital that we have behind us that we lend to you guys as real retail investors. A lot of hard money lenders have just like one private high net worth individual, basically that's their balance sheet, where if that he or she says, I want to take a break because I don't know where the market's at right now, or we're going to slow down and not do new construction, that hard money lender, whether you guys are in the process of a loan or about to get into it, has to go on pause because that's where his funds are coming from. We wanted to get like a wide set of like Wall Street warehouse lines, high net worth individuals, also some like family offices, just different lines of capital. So if that ever happened, like during COVID or times like in a rising interest rate environment, we were still going to be able to lend full speed ahead, because if one of our sources shut off, we had 15 others to go to, right? So that's where we're kind of like a bank where we don't have a capacity. Like sometimes you can only take out 3 loans at a time or have $1 million in exposure. Like since we have these different places to place our loans, the sky's kind of the limit for working with us. So we call ourselves an alternative lender because we kind of fit in between the two. As I continue to like talk about more about us, you'll be like, oh, that sounds like hard money, or oh, that sounds like a bank. So we do require some documentation. Some hard money is literally like over the phone, like, yeah, why are you $50,000 tomorrow to send something? So we're a little bit different than that. We still need to close in an entity. So I don't know, for the newer investors, if you guys have looked into setting up like an LLC and things like that, that's a great place to start. And the advantages of setting it up are you can look them up and do your own research, but like separating your personal assets from your business assets and things like that. So we require an entity to close in an LLC, like your driver's license, and then it's really an asset-based lending experience. So what I always joke around is if it's a good deal, I want to lend you the money. That's what it really comes down to, and that's where the hard money asset comes into play. So I can dive a little bit deeper into like specific leverages and loan terms, but if you look at it from 2 main silos, we have bridge financing, which is your short-term bridging the gap to where you want to go, right? If you're fixing and flipping, as someone said, you need funding to purchase the property and rehab it to bridge you all the way to the sale. If you're looking to hold something, you want to bridge your financing from buying something to fixing it up to then holding it. So our short-term loans are typically from like 12 to 24 months, depending on the scale of work. If it's a new construction of a quadplex, might look different than like a $10,000 cosmetic renovation. But anywhere from 12 to 24 months, it's an interest-only loan, meaning you guys are not paying any of the principal balance that you're borrowing throughout the life cycle of the loan. That's all paid back when you go to refinance or sell on the back end. So that typically can lead to cheaper like holding costs while you're renovating. You're not paying that much to borrow the money. And then we're one of the few hard money lenders that can do that bridge type of financing, but also refinance you into like a conventional 30-year mortgage. So
Oh, that's neat.
yeah. So
That's where the bank comes in.
yeah, so that's where we're a little bit different than the hard money, and we can do Airbnbs, sort of like qualify off short-term rental income and things like that. So our product set is pretty unique for the space that we're in. So you got your bridge funding, like I said, for anyone that's flipping, doing new construction, that's kind of your short term. You got a plan, And your rental financing is, it's ready to go, we want to get a tenant in there, I want to just set it and forget it, being a 30-year conventional mortgage, so we can also do that, so.
Wow.
That's a super high level overview of who we are and what we do.
And we'll dive more into that.
Yeah.
So I'm sure you guys have lots of questions. I have like 7.
Yeah.
But let's switch to Jeff real quick. Can you share a little bit about life insurance and cash value, et cetera?
Sure, so there are a bunch of different ways that you can put your money into life insurance. After meeting with you, I thought that coming to talk in this presentation, that an indexed universal life is probably the most beneficial for most people in this room. It's a life insurance policy, but it's also an investment tool. You are going to get out of it what you put into it.
Does anyone know what that is? What he's just said? Most people don't. Yeah.
Okay, we'll get into that too.
Cool.
But not to get away from that, but also what you said as far as the Airbnb, you need a special kind of insurance for that. It's not just your regular insurance. So, and that's something I do also. But yeah, there's term life, whole life, and we're going to get into the differences between the two. It's really a matter of what it is that you want to do with your money and how you want to protect your investments. And you can go one of two ways, is the best way to describe it.
So I have a quick question about
Yeah.
that part of things.
Sure.
So you provide the life insurance product. Do you also consult on what the person's goals are, or do they need a financial advisor to consult them to you to figure that out?
So most financial advisors are also life insurance licensed.
Oh, interesting.
So I'm not a financial advisor. But at the same, in saying that, a financial advisor has a life license because they're selling a product that they need to have a life license for. I don't have a Series 6. So when you sell life insurance, there's term life, and that is pretty basic, right? Whole life, it starts to get into annuities. And that is where you would want to put your money more in long-term and investment. So ideally, you want to have your life insurance license and your Series 6 to be able to sell both.
I'm gonna share. So last grid, we had financial advisors here purposely so we were talking about IRAs and syndication, and they are excellent at that. But they made it very clear that their specialty is not this. And so it's funny when you have somebody who has that ability to sell you a product like Jeff can, whereas Jeff's like really subject matter expert when it comes to, hey, I want to pull out from my life insurance policy $50,000. Can I do it? Like, that's a consultation conversation.
Right.
Okay.
And life insurance is so specific because it really is going to matter on what is it that you want to do, like with your money. How do I want to protect my assets and investments? Do I want to do term or whole? And the reason I say that is because there's a big difference in the two, and there's a big price difference in what you pay to protect term versus whole. So we're going to get into that. We can talk about it.
And I know you have a presentation, but what is the difference between term and whole?
Oh, okay. So I think the best way for me to explain it in layman's terms is term insurance. Think about it as you're renting a policy. I don't own it. It's only going to be for a certain amount of time, and it is a lot cheaper than whole life. Whole life, you own it. And it covers you for your whole life, right? So an example, like when we met, was Rebecca explained to me, she's like, well, when I buy a property, I will take out a term policy on the length of the mortgage or the amount of the mortgage.
Yep.
And that makes a lot of sense. You should do that. Whole life is gonna be a little bit different because you're kind of, I would say, looking at the big picture more so. One good thing I will say about term life is, and especially with selective, is so obviously you want to buy term life sooner in life than later. And the older that you get, the more expensive it is, but they do offer a program that is a little bit different than most, where you can do 35 and 40-year 35 and 40-year term policies, which is a little bit different. Like most companies won't go past 30 years.
That's like assuming that you're gonna live until 80, like well, 75 in my case.
Right.
But like, I wanna live longer than, right, like, yeah. But like, people get life insurance because they wanna protect their lives, and oftentimes people don't opt into it because they're like, oh, I'm fine, I'm gonna live. But like, my husband has like multiple policies on me because if I pass away, literally he has like $3 million in mortgages that he would have to cover. And every single one of our properties has insurance on it for that reason.
Can you talk a little bit more about that? Just because I've never even heard that before. It's pretty interesting. Like, so every
Right.
property, can you explain that investment?
Well, I mean, if you bought a $300,000 home,
All it fix and flip or something?
well,
No, it's usually holds, like for us, it would be holds,
It's like
like
turnkey, ready to go properties.
that we have mortgages and tenants in.
Okay, And
I'll use this building, for example,
Okay.
and I'm not a licensed insurance agent,
Yeah.
so like,
anything you would say would be more than I know.
well, so like, when I was getting in this commercial loan for this building, they required me to add the mortgager onto my life insurance policy, which at the time didn't cover this building. It only covered what I had at the time. So we had to take out, or we opted to take out another policy just for the building in case something was to happen to me or my husband. Really me, because it is me, solely me. That way the mortgagers completely paid for, but I also added, I think it's like for $1 million of the policy versus what we paid for it, because I wanted to have some cash value that I could loan myself some money over time.
Wait,
right, like
what does
there,
that mean?
so, right, okay, let's back
So
up.
we're getting, yeah,
It's okay. There are endorsements that you can add to insurance policies, and that's gonna be on term or whole, it doesn't matter. But term insurance, like how I said, when you rent, there's no cash value to term. Right, so it's just gonna cover you for what you agree upon at a certain amount for a certain amount of time. Whole life it gives you the benefit in the fact that what you put into it, you can borrow against, you can use it for multiple different things.
so like, for example, if I buy a whole policy, which I did last year, and what you put like for my bracket, I put like $9,700 into it for the year. I just put $9,700 into it. Well, my cash value at first, I think is like, I don't know, $750. It's like super low. But then when you look at the 7-year amortization for that particular policy, I have $1 million sitting in a bucket in the next 7 years because of the stock market or whatever we're invested in. It just over time is always going to appreciate because the stock market over time always appreciates at least 4% every year. So it's what Jeff's saying.
And
is
this will make more sense when I like actually
so
show
like,
you.
you get what you get out of it. Initially, it's an investment and you're just trusting in the process later, but you can take loans out of it before you get to the 7 years.
So now what about, okay, so I have a whole life policy through another company, I think this is like maybe, that when we took it out when I was 30 and my son was 1, now he's 20.
Yes.
I've been paying $600 a month for all these years. So now can I use that to invest in other stuff, or am I kind of, I use it, I put it aside for retirement, obviously, so.
So it would depend. Do you want to replace it or add?
I
Because,
want it to grow.
right, so there's a big thing with, I'll put it this way. I never really want to replace anybody's current life insurance. Mostly because you have to jump through hoops to do that. I have to prove to you and everybody else that it's a benefit to you to replace it. You don't ever really want to replace life insurance. You only really want to add to life insurance. Does that make sense?
Well, and to answer your question, really, you have to look at the terms of the policy. And if there's cash value that can be borrowed against, like you'd have to go back to the policy initiator to find out what the red tape and the black and white print looks like. Because there might be an opportunity for your son to borrow against it or play the arbitrage game, which is charge an interest rate for the money that they're lending and then put it back. You always have to put it back in over time. But like become a hard money lender.
Now I'm seeing the
Connection, right,
the topic would be the day.
Yeah.
Right.
I get it.
Right.
But like-
With life insurance, you can be your own bank.
Right.
It's just a matter of how much you want to put into. And also, you can't overfund it either, because then it's
Right.
not a life insurance policy anymore, it's an investment. So.
But you can get multiple ones, and then, you know, if you have to overfund it because you paid so much money and you need to hide the money
You
somewhere,
can do that.
right?
Your death benefit just increases.
Yeah.
Your death benefit has to be more than what you put into it. Does that make sense? Right, like
Rated by
if
the end.
you put more into it than your death benefit is, then it's not really a life insurance policy anymore, it's an investment.
That, I understand that.
I mean, it is
It's a lot.
fascinating what you can do with insurance policies. Like oftentimes, at least when I was younger, like you put your money into a 401k and you let it sit and you let it do its thing. And then when you start owning your own business, like if you have this opportunity to own your own business, oh wow, IRA is a better vehicle, or solo 401k is a better vehicle. Move all your money over to whole life policies. Like there's opportunities for you to literally become the bank for yourself.
And death benefits on life insurance, there's no tax.
And God forbid if something was to happen, you're like massively protected with your family.
So I don't have life insurance, but I have an IRA. So is that like, there's a different avenues I'm seeing here, is like an IRA and a whole life policy, like it's okay to have an IRA and then also do all the
Yeah.
Oh, yeah.
Yeah.
You want to be diversified big time.
The first one I family to learn all this.
Well, and congratulations.
Yeah, you're 25.
Yeah, that's huge.
That's your.
So I
great
yeah.
spot.
Yeah, yeah.
That's the whole point.
And I just purchased a insurance
Okay.
policy like about a month ago, so now. I mean, if it.
Well, sure, talk about that, like what, I mean, do you know what you purchased?
Yeah, I purchased legal policy myself, $2 million for my husband. He was on the roofs every day.
Yeah.
And then I have one for my 8-month-old child. She was like a $24,000 policy for her. But with the term policy,
Is that term for her though? Or do you have a whole life?
it's a whole life for her, because I guess it won't change over time.
Right, but it'll probably have cash value.
Yeah.
Like that's what Vince is saying, like you just created a massive legacy builder for your daughter.
Yeah, yeah.
Terry Young is big about that. She was like, all my kids have these, and I specifically did this, and
Another real estate agent.
But from a term policy, can you do those investments with it, like over time? You can't with the term.
Yes, it would just change from term to whole, and the earlier or the younger, better.
Cause we just got into the game, started making money, so, you know, those whole life policies are whole.
Yeah, yeah,
And I think it's important to note, like, you're protecting your life when
Right.
you're getting that term policy. Like, that is smart. But now go buy some whole life.
Okay.
right, like, so, and I think this is what kind of stuck out to me when somebody was presenting to me about life insurance. Some life insurance is better than no life insurance, right? So term is a good way to start. And then eventually convert it to whole. Whole is better, it just costs more. But there are so many more benefits that come with whole life versus term life. There's no cash value to term life.
So question on your side of things, if you have somebody like Rebecca who has multiple, insurances and multiple different ways of having cash value, would you consider someone like her a high net worth individual that could be an investor for you guys? Or
So-
how would that side of things work?
Yeah, that's a great question. Two parts to it. One, yes, I would, but our style of lending isn't based on her debt to income or anything like that. So like, she would qualify for the loan with us because the deal she's bringing us was good, not because she's got several life insurance policies. But to answer your question, a bank would absolutely look at that. And then with the use 50% of it, like, I think for liquidity requirements in typical banks, like you go to Wells Fargo down here, you might take out a loan. They usually use 50% of your retirement account, or if you have like a HELOC or something like that. I don't know what the life insurance would be 50% of that or not, but she could certainly use borrowing against that as part of a down payment to put for a loan. There's no seasoning of funds or anything like that, or doesn't have to go from her life insurance policy to her bank account and then for us as the lender. So I hope that answers it, but
Were you asking, like, if they're collecting high net worth individuals to,
Yeah, so I
like,
was
the
kind
fund?
of more asking like, if
Oh, on
you
our-
could be like the back end.
oh,
Probably not, because you're not relying on whether or not one individual.
you're saying like use some of her money to lend to you?
Yeah.
Okay. I'm not sure.
I'm just trying to figure out
yeah,
how
I
to
mean,
do
we're
all
always-
these things in that.
Yeah, we're always meeting with capital partners that are willing to invest, and we have a fund ourselves, obviously, that we like hold some stuff on our balance sheet, and you've got to be an accredited investor to get into it.
So like syndication style,
Yes.
Yeah.
Yeah,
but not, yeah.
it is, it's just like, instead of it's at our discretion, kind of what we invest in. Syndication, sometimes you know a little bit about at least what
Yeah.
apartment giant multifamily you're getting into. For us to be like, we'll kick you back a return and we're gonna use our fund how we want to spend the loans. But I didn't even connect what you were trying to say, but yeah, she definitely could.
Well, and so, Jeff, like, if you wanted to invest in opportunities, like, I think reaching out to some of these hard money lenders. Yeah, I like where you're going with that.
Yeah,
But like,
they're
they're
like,
drawing it.
there's something like long-term passive income is to
Right.
be the investor that someone else is
Correct.
hoping money
Absolutely.
from.
Yeah.
Yeah.
Well, there's things, so our first grid event ever, you were there, Dominique, is literally creating subsidized housing, like free housing for senior citizens
Okay.
through, a angel investor, basically. But now she's funding, like, there's multiple investors that she's serving, where she's literally just buying these senior folks who can't afford their homes. She's buying it from them with these angel investors and then just letting them live there for free for the rest of
Oh,
their
my
life.
bad. Wow.
Yeah.
I was-
You know it, yeah.
I was curious. I didn't really knew how it worked. I guess they are government subsidized paying the rent, and
I don't even think it's government. I think it's literally an investor just is subsidizing.
super long term. Like, I don't need monthly cash flow. I just want
Correct.
property, whatever.
She's getting, well, number one, she's getting charitable giving,
Right.
right? Like all of it's charitable giving, so
Yeah.
it's written off.
Yeah.
Number two, when they pass,
Right,
because
right.
it's all seniors,
Yeah.
when they pass or they move on,
You own the
now it's their
pretty
property.
clear, yeah.
Exactly.
Hmm.
I mean, it's so brilliant.
It is, it's a long game, but it's definitely can be super profitable.
Well, and so things like that, like when you're talking about high net worth individuals, like that makes a lot of sense, because
And
that's,
it's not at all involved with like HUD or anything.
no, I mean, I don't know how they're doing the closings and stuff, but no, it's all angel investors. Yeah, just like flow, you know,
Yeah.
more things flow.
It all-
Your question is like.
I feel like we started here, and it's just like each time this group meets, it's just like we're just stacking more information.
Yeah.
So,
Yay,
yes.
Yeah.
it's happening.
You have to connect the dots between what, you know, everybody is an expert in their area,
Mhm.
but we don't always think about how your expertise and his expertise
Right.
and her expertise, like y'all probably doing something together, and okay, I can participate in that too. So,
When yes, I could talk about all these different topics. That's why I'm leading this group, but I don't want to know what everyone is up to. I want to bring these people to you. And like next month is apartment. What did I don't know. It's like apartment syndication, basically. And so I'm like, ooh, who in Charlotte do we know that's really doing this at a high level that we can just like attract to a big group like us, you know?
as soon as you tag me in that post for next month's, it had something to do with apartments. All
Yeah.
my Instagram ads changed to, well, why don't you want apartment buildings?
Why not? Why not? You know how to get some money.
All the bigger shoes online, every other Instagram ad, I know they're watching. I was like,
Right.
no, you
You're
don't.
listening.
I don't like it. Did you find somebody for that, by the way?
I haven't, no, so
I know the perfect person, I think.
Awesome.
Yeah, we'll talk about
thank you.
it. Yeah,
I mean, we've got like a whole year next year
Yeah.
to fill with stuff, so like,
Right.
let's keep going. Let's find other.
Isn't it
venues.
weird though, when you see ads like where you didn't type anything?
You just thought about it.
You thought about it.
No, that's called retargeting.
That happens.
Yeah, called retargeting and Facebook knows what they're doing.
Somebody else said it in your phone.
Right.
Yeah, exactly. So I have questions
Please.
that I was gonna dig in. Does anyone else have questions around?
I mean, yes.
Yeah, so keep going. Shoot, yeah.
So with what you guys do with, well, you said that you fall into the hard money category, but you don't consider yourselves like a hard money lender because you call yourselves alternative lenders.
Right.
So when, just from my third party observation of wholesale transactions and seeing from the sales and acquisition side frustrations with the way that the money goes in and out to their buyers, investors, and all that kind of stuff, which I obviously don't see contracts and things like that. The biggest frustration on the money side of things is that things get caught up in well, not necessarily the underwriting, but the property value estimate is off based on what the wholesale firm paid, what the investor offered,
Right,
and
right.
then what the hard money is willing to pay.
So you're talking to like financing off of the purchase price rather than an as is value when
Right.
you go to something. So yeah, I mean, it's always a point of contention because you don't want the wholesalers to artificially inflate these values and us over leverage a borrower that can't handle it basically, which is where caused them this entire financial crisis, right? Giving out loans to people that weren't able to handle the leverage. So the underwriting standards are a lot stricter now. So we allow, I think I want to say up to a 10% wholesale fee, but if it's New Western, right? That if your partner from New Western finds a house for $10,000 and tries to sell it to the next person for $100,000, and even if it gets appraised to that, if it was worth that to a bank and lending firm, it would have sold for that. Like that's kind of our bottom line. If it was worth 100,000, it would have sold for 100,000. Now, if he's wholesaling it for $12,000, right? We're like, okay, that we can wrap our head around, right? So, I can see the frustrations from the borrower side of like, look, an appraisal is really literally saying it's worth it. But from, again, like I have to like wear my investor cap sometimes and my lending hat sometimes. As an investor, I'd be like, I want the full financing because it's worth that. But then from the lending, I see like in a super uncertain market like where we are today, and as is values are kind of hard to trust. Just as you guys, let me flip it a little bit and then I'll bring it all back together. When you get a DSCR loan, are you guys familiar with that? Right, it's basically your rent is qualifying if you can afford the mortgage or not. So that's what we can get into that topic. But if you have a lease amount saying you're renting a property for $2,000, but the market rent is only $1,000, right? We're going to use the lease saying it's 2,000 because you literally have that, right? So where I'm going with this is when you buy a property for only $100,000, even though market is saying it's $200,000, we're going to go off the purchase price. Like what people are signing and transferring is gold in this industry, right?
Purchase price, not what the.
Appraised value. We lend off the less certificate, right? So even if the market appraisal is saying this house is worth 150 and you're buying it for 100, we're going to finance on 100. So, and I'm saying like that, it stinks for borrowers in that way, but it's also works for you guys when you get rental loans and you're leasing the property way more than the market rent is. We're not saying the appraisal says it's leased for 2,000 is the most you can get for it, but you're getting 3,000, we're lending on the 3,000. Why? Because you have a signed piece of paper saying someone, we're going to pay you $3,000 every month. Just as if you're buying a property, you got a signed transaction saying we're selling you this for $10,000. To me, that's what the property is worth, right? So
in that case, so follow this,
Mhm.
okay, you're lending on that purchase, let's assume that we're gonna create a reno. Are you guys able then to wrap around the renovation a loan on top of that?
right, yeah, that's all the loans we do. Like we rarely do bridge loans without renovation. We've done more right now because refinance rates are crazy, but we fund 100% of the renovation in all the loans that we do.
Okay.
Right, the difference that the borrower has to bring is towards the down payment.
Are you requiring a contractor's quote in order to do that, or we're just making an
For
estimation?
us, like experience is gonna trump everything.
Yeah.
If you've done 10 fix and flips, you could hand scratch out here and
Sure.
fix this one and I'll be like, sounds good, just do the way you did for the other 10, right? You've done it before. If it's a first time investor, I'll make sure that they're at least consulting, preferably working with a licensed GC and they got that quote, just because if you've never invested, you don't know what you're gonna find in the house until you get it.
Yep.
Like as much as you think you are planning out for. But
Are you physically going, are you going to the property, or you're just?
I'm not, I like to, you
Yeah.
know what I mean, when I'm meeting people, and like I walk contractor job sites every day and things like that, especially if we lend on the projects as a state, but no, I'm not. If the borrower understands the expectation that if the construction amount is more than the loan is, they just gotta come out of pocket for it, right? So we
Right.
always try to add contingency to plans, over budget, be conservative with it, because with our loans, you're not paying interest on money that you haven't borrowed. So if we're giving $100,000 to you for the purchase and we're holding back $100,000 for the construction, your monthly payment is only on the 100 we lend you for the purchase. I'm not gonna charge you for money you haven't even borrowed yet.
Right.
Right, so I always say, why not just make a extremely conservative budget? If you don't use it, you never pay for it. So that's kind of how we mitigate that, but the reason we kind of do a holdback amount, if that's maybe a question that you guys might have, where private money lenders are more like, in that same example, here's $200,000, go do what you have to do.
Right.
For lending in banks, what happened in 2008 was you had to foreclose and take back a bunch of properties. So if we hold back the construction funds and you guys run away, we never hear from you again, we now held back the funds to go finish the project of what originally was going to be done. And then we're able to sell it back. So that was kind of like a risk mitigation factor that lenders took on after 2008. So that's why if you're like, why am I not getting all my renovation funding up front? It's because you have to work off like a reimbursement schedule. So you complete work and then get reimbursed for it, complete work and get reimbursed for it, rather than here's $100,000 of renovation, go have fun.
So it's like construction of perm loan.
So the construction of perm isn't like a singular product for it. It's just that we're able to have the capacity to basically have the appraiser go, okay, your new as is value is what I thought the ARV was 6 months ago.
Yeah.
And then we just pay off your initial loan and put you into the 30 year.
Cool.
So
Which also, that's a different insurance policy that you would be.
for the construction firm,
Mhm.
yeah, so ours isn't one loan though. It is.
But I'm just saying, like, in
Yeah.
general, as far as like when you're renovating a property versus if you own it and live in it, or
Mhm.
if you own it and rent it out,
Right,
all different.
What
yeah,
was the liability of the construction crew?
yeah, builder's risk policy,
Yeah.
things like that, yeah.
Hmm. Okay.
So I don't even, that answers every question. Yeah. Yeah.
That was so good. Okay, so back to whole life. How can you fund and buy your own properties?
Really just putting the money into a whole life policy and then borrowing from it. I mean, one thing that I really like about the whole life product that they have is, and I even asked this of my bosses, if I'm sitting in a group like this, my first question would be like, it sounds too good to be true. Like, what's the disadvantage of it? Well, you're not going to make a ton of money quick. I would say that is probably what the disadvantage might be, but you're never going to go below 0%. So I have like a screenshot in here about like how the market has performed over the last 20 years. And if you had a whole life policy, what that would have had done for you in the last 20 years. And it's really interesting to look at because in 2008, when the market lost almost 40%, you were at 0. So you didn't really lose that much. On the same flip side, though, recently, like when the market is at 30%, you don't get that benefit. There's a cap to the limit that you can make.
Okay.
Right, so you're never going to make a lot of money quick in that. It's kind of more for long term, but you can borrow off of it as opposed to term where there's no cash value.
So like, for example, I'll give everyone an example. So if you have, let's say, $14,000 cash value, like if everybody was to go out and get a whole life policy and start funding it within a good, 24 months, that probably would be a good number. So if you were to have $14,000, you'd probably be able to take out 6.
Oh, yeah, right. There's a
You wouldn't be able to take all of it out.
correct. No.
Question.
Yeah.
Is it like just a straight 1-for-1 exchange, like the 14,000 that you're able to borrow, is that how much you put into it at that point?
No.
Okay, got it.
No, you're going to be able to borrow less than what you put in.
Borrow more than.
So if
right?
so there's a cap, just like with a 401k, IRA, all of those things that you fund. There's a cap of up to like $9,700. I don't know what the number, and it's different for everybody. Like
Right,
for
it really depends what your
net worth is.
it depends what you're putting into it as to how much you can borrow out of it, right?
But it's not 1-for-1. Okay.
But eventually you'll see the,
Yeah, like the first couple of years that you put the money in, there's a surrender value. So if you said, okay, year 3, I want to take all the money I can out of it, there's like probably a penalty for that. But after a couple of years, the penalty becomes less and less.
What about borrowing against it rather than taking it out? Is there a prepayment penalty on that at all? Okay.
and then you're
No, surrender would be like taking it all.
Right, like.
Borrowing, no.
Got
like close out the account.
it, yeah.
Yeah, major tax disadvantage.
Mhm.
And then the other thing, like this whole thing is a tax strategy.
Right,
The whole thing is.
Mhm.
And so if you are, $14,000, you're taking out 6,000 because you want to give I don't know, most of us are real estate agents, a commission advance to someone. Okay. So you're gonna, that this person just is under contract on a deal. So you're gonna give them a $6,000 commission advance. But your interest rate on that $6,000 is probably like 7%. It's in alignment with what interest rates are. So if it's 7%, you're probably going to charge, just like a hard money lender, you're probably going to charge 10%. You're making that 3% difference And that's where arbitrage comes in, where you're literally taking your money and then putting it back into the whole life policy that then makes more money. But you're earning 3% difference of a spread.
And then also another good thing that came up recently too, say for some reason you die while you have that loan, you don't have to pay the loan back. It just comes off of the benefit, the death benefit.
This might be an ignorant question, but I'm gonna ask it anyway. So you have this policy, right? And this is just from places like, I just don't know anything about any of this. So you have this policy and you're borrowing against it. Is that a loan? Are you just borrowing from yourself? How does all of that work? And like Rebecca is saying, if you borrow against your policy, you use that money, you replace that money grows, you borrow again, you replace that money grows, you borrow again. Where do you lose? I guess I'm trying to figure out what are the downsides.
I mean, I guess the only thing that I can think of, the only thing that you would lose is that money earning interest.
Well, and it's
You're
income.
borrowing against.
You're also income, right? So like some of that is income that you're receiving, not replacing your loan. So if you're taking debt, then that's tax reduction. But if you're making money, then you have to report that. So then you have to figure out how to offset that. And it might be with more loans.
Oh, interesting. Okay.
So that's how you create a hard money. Basically.
Each time you make money on it, it's income.
Yes.
And that's where the overfunding comes in that you guys are talking
Well,
about.
you can't.
You
Yeah.
can't overfund it.
So if you borrow the 6,000 and made 10,000 from this transaction you did, you only are allowed to put the 6,000 back in, to put the 10 in.
Plus interest, whatever
Okay.
your interest is, but it goes back to you
Right.
as the
Okay.
borrower. And then, and again, I'm not an insurance agent, so if I'm not saying the right thing, but if you have $10,000 and you made 4,000, let's assume maybe, it was a really good year and it's now $7,000, right? To replace the interest. Okay, so the $3,000 is taxable, but why not offer that as a loan so that it's now a deduction? And then the whole point is you're continuing to grow that. It's just a vehicle.
Yeah.
So I'm confused on that. The offering the 3,000 as a loan.
If we had a calculator, it'd probably be easier.
Well, like I said, it really all depends on what it is that you're trying to do. It's very difficult to kind of explain what Rebecca is trying to explain without having a goal. I mean,
Yeah, we can use me as an example. So I'm 27. I plan to do real estate for 10 or less years and retire and to be a full-time world traveler until I get bored. And I'll find something else too. But I just know it's gonna. So someone like me, I project to have 10 income producing properties in the next 10 years. So if that's my ultimate goal, I'm ideally as the buyer on the buy side, I would be looking for something that's relatively turnkey that I can get above market value rent for. That would be managed by property management. So if I'm going to borrow against a life insurance policy for that, I'm going to borrow what I need to close on that property. And then the passive income that I'm making would be replacing that money. If that makes sense.
Yeah, you can do that.
Yes,
So then I can still be making active money practicing real estate during that time.
yes. Ideally, though, you would try to pay off that loan as soon as possible so that you're not paying interest on that on yourself.
Oh,
For example,
you are going to pay interest on what you take out.
yes. But the good news is it is technically going partially
it's all
going
your
back to
money.
you.
Right.
So you're not taking it out, you're borrowing.
Against yourself.
Correct. And does the insurance company charge that initial, like you mentioned the 7% and then 3%? Is the insurance company charging that 7% and then you're able to charge additional on top of that if you're loaning to someone else? Or is that 7% going back into your account as you repay it? Does that 7% become part of your money when you repay it, or is that a fee that the insurance
That's a
company?
very good question.
Yeah, I'm pretty sure the insurance company is charging that. But just remember that $6,000 is going back into your account.
Right.
So in the non-mathematical correct equation that we just used, if you're adding $7,000 as your all-in expense, only the 6,000 is going back into your account.
Okay.
But you're making 3% over the 7% if you're
But if
charging.
you're borrowing it for yourself, then you're not gonna charge yourself extra.
Bingo,
Sure.
Right.
That's what I did.
right.
The interest is your own.
That makes more sense.
You know what I mean? Like, even though it's being charged, like it's your money that you're making money on, like,
Well, and so, well, no, because the insurance, you're paying the interest back to the insurance brokerage for the borrowing.
So the interest is not your money unless you're charging an additional interest.
Correct.
Because you're doing it for someone else.
Which, again, like if we're talking about being the bank, let's say that you have the whole life policy and your game and your goal is to be able to loan hard money to people. Like, if you wanted to go buy a house tomorrow and you were like, hey, Rebecca, well, but like if you did, and you were like, hey, Rebecca, we have all the plans, here it is, can you help me fund this deal? Well, I have the resources to fund the deal for you. I would just charge you a typical interest rate. You don't need to know how much I'm borrowing for. Like, I could probably connect with you and be like, hey, here's the project, here's everything, and oh, by the way, it's not mine.
Right.
But that's the wholesaling part. Like,
Right.
you have the wholesaling mind, you just
Right.
have to think that way.
Right.
I 100% any deal that's in front of me, think wholesale first.
explain that a little bit more.
So
Wholesale.
wholesale is not retail, right? Like, it's usually 30% below market value. In my case, I try to get it like 40%, because if the market tanks tomorrow, I don't want the property. I want to be able to sell it to anybody. So we, between 30 and 40%, make an offer, and if they are in a dire problem, we could be their saving grace. And so we make them a cash offer, but usually on borrowing money.
Yeah,
Either
so
for
like,
myself or
if, for an example, I'm a full-time residential real estate agent. Somebody comes to me and says, hey, my neighbor's about to foreclose on their property. They want to know what their options might be. They probably don't have the time to go to market, wait for an offer, let it sit for 30 days, and then give a buyer 30 days to finance that property. They probably don't have that much of a timeline to work with. So Rebecca could scoop in and say, hey, let's do a wholesale opportunity here. Instead of you foreclosing on that property, why don't I buy it from you for cash? And then that saves the seller, nets them money, and she now owns a property that can either be income producing, or she can flip, or she can immediately sell, and she can decide what the future of that property looks like.
And we do that every day, literally every day. We all should be doing it.
We're learning.
Like you have so many connections and you
Yeah.
have money, right? Like you could literally just write, and I'm sure you are, but like you could literally just write letters at a mass level
Yeah,
and just buy everything.
I should.
You should. We all should.
And it's not even just people who are about to close on or foreclose on properties, it's people who are in any kind of situation.
Yeah.
Like, they want to upsize or downsize, and they don't know what their options are, because they haven't shopped the market or paid attention to anything in the news lately about real estate, and they just don't know what's going on. And they don't want to have the headache of going to the market and exposing their stuff to strangers and stuff like that. A wholesale opportunity might be better for that type of
Totally.
seller who
Completely.
doesn't care about maybe making $1 million on their property. They'll settle for a number that works for them in their financial situation.
Yep.
And anybody can buy it as long as they make their number that they need.
Correct.
And then it doesn't have to go to market, saves them.
That's why Open Door, not this last year and a half, but like, that's why that was such a great option. And that's why Orchard, I don't know how Orchard's making money right now, but like
Nobody does.
Orchard is a great product for people who think that they could make more money. Like, okay, so here's your cash offer, but oh, by the way, we're gonna take it to market, and if we get more than what we gave you, you get the difference. How do we make money off of that?
Are they like an iBuyer?
It is, it's kind of an iBuyer, but they're realtors.
I've never heard of that.
I mean, one of my houses, I just was like, ooh, I'm curious. And now I'm on their drip campaigns and I'm like, this is brilliant.
Right.
Except if they have to give the seller, they are banking on the fact that they will not make more money going to market than they gave you originally. Because if they make more money in multiple offers, then they don't profit.
Wow.
Like
Yeah.
Mark Spain or Open Door or
Right.
those companies.
Right.
They're literally giving back that money, but they are banking on the fact that that was the best that you could have gotten.
It is, yeah, it's more, is it like a high origination fee, maybe, or how they're,
I don't know, I haven't gotten there yet.
yeah.
I'm waiting for
That's-
them to
I'm
like
curious,
give
too,
me
'cause
everything.
They gotta be something, they gotta be sure, right?
Well, and I think they do have a loan product.
Okay.
Kind of like Knock. Like if, honestly, like regardless if you're in real estate as an agent or not, like I think everybody should be on everybody's drip campaigns so that you can understand what the market is doing. Because if you're an investor and you know that Knock could potentially be an option on the loan side, or you have your hard money, you have everything is going to come into play like in the next 18 months. And get a policy where you can fund your own stuff.
I was gonna say the last 18 months and the next 18 months are gonna be, things are changing so much.
So question, in what situation would it be more or less beneficial to use something like your loan product versus borrowing from your own term life policy?
I would say, and you answer this, where we get tapped in a lot is from like a scaling point of view, right? Like you've got to do, you're doing 1 to 2 properties every 6 months and you're like, this isn't working fast enough. I want to leverage some more debt. I want to do 4 to 5 a month, right? So there might be some, what's the word I'm looking for? Like limits to that, where we can kind of help expand you if your crew can handle it, if you're finding that amount of deals. So we're working with a ton of general contractors that had just private money lenders that were funding them to build 2 houses at a time, right? But with the lack of supply, like, and this is changing a little bit now, but before it was like you couldn't build these houses fast enough. A year or 2 ago, they were selling a hedge fund, selling that you guys know, like without even on the market, pre-sold. So we came to play where it was like, your private money lender is giving you a certain amount of money that you're able to do 1 or 2 at a time. Why don't you take his money, use it as like a down payment for our loan and build 10 houses at a time? Right? Yeah, I can, is that a whiteboard?
It kind of is, but not really.
I was gonna say, I think that, to think of it, like if you needed $200,000 for a lot purchase of 20,000 and 180,000 to build a single family house. Instead of doing it where the private money lender was funding the whole thing, they were taking that 200,000 and giving them whatever return they're giving them and using it for 8 different down payments on lots where we would fund the renovation from that point. So it allowed the contractor to go from building 2 houses to 10 houses in the same amount of time. So where we really fit in is nice, is coupled with using these other strategies, right? Like it's great to have 6 different lending sources in your toolbox and like everyone's gonna be better at something, you know what I mean? So I think when it comes to growing and scaling is where we really shine. And then for your, every hard money is gonna be great for your typical like non-QM borrowers, I would say. Like if you've got a low credit score, a lot of banks won't lend you construction on something that's never done it before. If you are self-employed, it's hard to get a bank loan. So we fit in for those like people that don't fit in a great bankable box. It would be a good option for us, or growing and scaling. So, and
So
then I'm
if you
sure.
did something like pull from the life insurance policy to do a down payment, like you mentioned on
Right.
say like 1 house that we were gonna flip with the crew,
Right.
we could take that money and go to you and you
Do 4.
do 4.
Right.
Okay.
Yep.
Interesting.
Right, like I would say that's what it would be good for, is like down, like taking money out of it, split a down payment. Not necessarily like funding a whole project, Only because it's really more for long term.
Because doing 4 instead of doing 1 would be able to put that money back quicker.
I think the biggest thing, and yes, fund your own deals, but the biggest thing with this opportunity is that you can loan to other people. So it's your money. Like, don't think about buying the houses. Like, that's the perfect fit for that. This is lending to other people. The best book is the Banker's Code for this. Well, the Wealthy Code and then the Banker's Code. We did like started it. Okay. So the Banker's Code, and it blows your mind because you're like, oh my God, this is so like, I'm elementary and that is so advanced.
Yeah.
But that's where the breakdown of don't go, like, get the term policy, like protect your life. But then here's the whole life policy, and take one out for every single one of your family members. Take one out on like your construction crew. Like, you guys could be funding your own deals instead of who you guys are working with, one of the big guys, right?
Main Street.
Yeah, Main Street, that's it. But like, okay, Main Street has all these properties, cool. Well, why don't you guys just buy all these properties and have your crew, doing that instead? I mean, I make it sound so easy, but like,
Yeah.
That sounds easy, that's right.
Question on the whole life policy, whenever you pull the money out of it or borrow from it, because you're not pulling it out, you're borrowing against it. Whenever you do that, is the money that's originally put there, is that still growing because this is borrowed money? You're not taking your original cash, correct? So that money is still growing?
So in the product that we have, you have 2 accounts, and it'll make more sense when I put it in.
Okay.
I understand what you're saying, and it'll explain it.
so do you want to play the video?
Yeah, sure.
Yeah, play the video.
All right.
If everyone can see the video, that'd be awesome. We did introductions, by the way. So do you want to share who you are and what you do and if you have a project?
Sure. So my name's Ross. My last 2 businesses was a landscaping company and then a kickboxing studio. Sold the last one at the beginning of COVID and bought 7 properties out in Salisbury. I have no clue what I'm doing, but I accidentally fell into it and it's worked great. So I basically retired 2 years ago and spent a lot of time traveling, and I always keep an eye on the market, and every now and then a deal jumps out and like my gut says, ooh, this one, and I do something with it. I just did my first flip. I'm supposed to be selling it in 3 weeks, and I'll make about 120,000 on that one. I did it completely by myself, and
Will you 1031 it into something else?
I'm looking at that option because
Yeah.
part of me wants to take the cash and do some other things, and part of me wants to just roll it into something else. So I've been looking at other properties. I found one today that I may be a good opportunity. So
Cool.
we'll see what
I
happens.
love having that control, like literally, and you know this about me, like I love that conversation because then you have all this like opportunity, and if you decide that you just want to keep the money and take the tax hit, whatever, but like there's opportunity zones that somebody could just roll that money into an opportunity account, and then you don't have to do anything right now with it, or you could buy another house or whatever.
Is it a myth for a 1031, you need to have the property for a year? Is that not true?
I don't think so.
Okay.
I heard
You have?
I heard.
Yeah.
I don't think.
I try to, I think, work with an investor who is in your same exact situation and try to 1031
I
to
think
the
it's
next
more about
property.
intention.
Say it again.
I think it's more about intention.
It was to do the same exact project, but they were told
I
no
don't-
to buy whoever they talked to before because they didn't have it for a year.
It's based on intention. If you
Okay.
plan on buying it and flipping it, I think there's a rule that kicks into place, but as long as your intention is to buy it and rent it,
Let's look into
and
that.
then something
Yeah,
changes.
maybe, I don't know.
Because the
That's
whole,
my understanding.
the whole point of a 1031 is to offset the tax, so,
Right, it was lifetime change,
Yeah.
right?
yeah. Yeah, okay, we'll just keep walking, we'll keep talking. Yeah, let's look into that, because I'll get back to you on that.
The 1030 question I forget, I hear a lot of people say that it avoids taxes, but it does not. All it does is defer them.
That's correct, yeah, it's different. And then the cool thing is with opportunity zones, which again, like I'm just throwing stuff out here, y'all. But opportunity zones, if you're doing 1031 exchanges, it does not make any sense because an opportunity zone will offset any gains you have, regardless if it's real estate related or anything. Like if you won big with gambling, for example, take all of that money and put it into an opportunity fund to then find a qualified opportunity zone. And then all those gains are deferred also. But
This opportunity zone is similar to a 1031, it's just a type of fund that you can.
yes, it's just deferring your gains longer.
Okay.
And for the last year or so, no, I'm sorry. When Donald Trump was the president, there were a lot of benefits to it, and that all went away when Biden went into office. So there's less
Opportunities.
yeah, there's less opportunity zones, and then there's also less of your deferment ability over time.
Okay.
I mean, it still exists, and people should be looking into that as an opportunity, especially if you have other tax gains to offset. But it doesn't make sense to take your 1031 property and then put it into an opportunity zone. It makes sense to put your gain into the opportunity zone.
Those are mostly centered around like affordable housing.
Mostly. The funny thing is, not funny, but like in Charlotte, for example, most of that's on the west side of Charlotte.
Yeah.
And
There's massive opportunities then, right?
massive.
Yeah.
And if we look at it, like those areas, like we could probably scoop up 5 or 6 houses over in Seversville, or maybe not so much there anymore, but like right outside that area for maybe $200,000 a pop.
Right.
And then build a $700,000 property, and all that's offset.
Right.
Like I love opportunity zones as an opportunity.
Yeah. There's a lot to learn about.
Yes. Okay, Jeff, we're ready.
Okay,
When you are. We should do a whole thing on opportunity zones
And affordable housing.
and affordable housing. Any other questions for Eric while I'm texting?
I got a question. What did you do for financing on the fix and flip? Out of curiosity.
Cash.
Cash.
I have no clue about it.
Okay.
I literally did everything and I figured things out, and
Nice.
so far, most everything worked pretty good for me. And now most of my time has been on the cruise ship.
Nice. Can't argue with it.
Yeah, you were like, I'm going on a cruise. I'm like, oh, okay.
I've got 23 cruises booked right now.
That's awesome.
oh, wow.
Are you ready?
Yeah.
Okay.
I will just hand you that and I'll play this and it'll hopefully make a little bit more sense.
So Russ, we might have to get over here. Is there shine?
Next universal license, which are the same. Index and choice you balance, bring it up for those who want more than just death benefit coverage, but also want to play it safe. Protecting index choice UL has 2 interest accounts that work together to help build cash value, an index account and a fixed account. When you allocate premium, this is the index account. An index segment is created and earns interest based on the growth of the S&P 500 index over a 12-month period. Paying interest on the S&P 500 index's growth up to a 9% rate. This way, you benefit from the index's growth potential, but are also protected from the possibility of loss. If the index performance is negative, your policy will never return an interest rate less than 0%. In other words, your policy will never lose value. You can also allocate premiums to the fixed account that earns an annual interest rate of 3.5%. Either way, your policy's cash value grows tax deferred. With protected index choice UL, you have the flexibility of accessing your policy's cash value down the road for college tuition, home renovations, to supplement retirement income, or even to help with managing life's unexpected expenses. Talk to your life insurance professional about how protected index choice UL stands the test of life.
So when he was talking about the different options, yes, all those, but really for whatever you want. I mean,
Yeah.
it doesn't, it's not like it's exclusive to those things that you mentioned.
Right. Well, and unlike IRAs, are you using this again? Okay, cool. Unlike IRAs where it has to be a real estate purchase, like you can't just loan it because like all of a sudden a disaster happened. This you could just borrow. So that's why I'm saying, like, yes, personally awesome, like borrow against yourself. That's the whole point of having this money out there. But the game and the conversation today is you are the bank or you have a hard money opportunity. Well, why are we not that for people? Like you have money sitting, like here's an opportunity for you to use that as a vehicle, charge an interest percent. Like I love seller financing deals because seller financing, name the term, put the down payment, have a balloon or a balloon at the end of the term. And oh, by the way, if they don't pay, it comes back to me. They foreclose.
You own the property.
You own the property. Like, yes, it's deeded, it's mortgaged, it's just like a normal transaction. But if they don't pay, it's yours. I mean, I don't want properties back, but like, I'll do a seller deal all day.
I've done 3 of those and I always put the 5-year balloon payment. So
Smart.
only the first 5 years of interest and then your finance.
So smart. And right now in this market that we're embarking on, like we should be structuring seller financing deals. We also, I have loans on all of my properties just from a tax standpoint. I'm sitting here like, okay, how do I create a note for the equity that I have on every property and then loan against those notes for, a 15% interest. And it's like, it's fun, like thinking like that, Like, how do I make money? And then you have to create an entity for that. And yeah.
So that video, I think there were 2 questions that came up. So
Sure.
when you talked about the locked versus the indexed, and I think it was the indexed one that I guess just the word got thrown out there, is tax deferred to.
When you cash it out, like when you use the benefit or take out the money.
So
Death
when you,
benefits are-
Not that benefit, no, but like.
but if
the
you
loan.
borrow against that policy, are you taxed like that's income?
No.
Okay, I guess that part was confusing to me.
So when would you actually file tax? You're either getting the death benefit or you're borrowing against it.
Yeah, you wouldn't,
Yeah.
it would go to your beneficiaries when you pass. If you have it,
Right.
yeah, as a dolphin, yeah. So your deferrals until that.
Oh, so you can borrow from it as many times as you need to without paying taxes on it during your life.
Yeah.
And then it's taxed before it gets to your beneficiaries and back.
Well, you die, your benefit pays off. the loans.
Well, when somebody gets paid off of their tax benefit for life insurance, it's not taxed.
Got it.
What about in your retirement, you just
Your wife
start
will
one
tax.
collecting off of it, and you just start cashing them out?
It would depend. It would depend on what type of products you purchased, whether it was a whole life or an annuity.
Yeah, this is the long game. Like,
Right.
this is not like an IRA where like you're rewarded it after 65 or whatever that age is.
Well, and that does come into play a little bit depending on what product you buy,
Right.
as far as the age and taxes and such. As far as what I just gave you guys, I started out doing auto home insurance, and I've been licensed since 2008. But the first QR code is like, if you just want to send me an email, all you do is take a picture of that, and it will just. I'm so new to these QR codes. Okay, but anyway, it'll just pop up your email and send me one. So that's awesome. There's a couple other like just interesting things in here that I put together that I thought would be beneficial. The one that is, I did a term life insurance quote just for me, a 39-year-old male, South Carolina, 500,000. And I thought one thing that was interesting in the statistics was most people overestimate the cost of insurance by 300%. For a healthy 30-year-old term life insurance policy, it's $22 a month. And I mean, I'm 39 and a 10-year term is only $28 a month. Like, that's cheap. And even though I sell it, like, I think that's probably pretty accurate. I don't think that I would have thought that life insurance for 500,000 will only be $30 a month.
Yeah. I mean, it's like, I mean, it makes sense. You just go get it.
That's a 10-year term.
10-year term.
So you can't use that for anything.
There's no cash value. Right, so like that's the big difference.
So that's only for leaving it for somebody behind. There's no benefit to you. It's only to take care of your family.
Right, like if you had
Correct. No benefit to you in real time today borrowing.
but like if something was to happen to you and you had multiple assets that needed to be protected from mortgage, which you don't have that issue, then at least that loved one is totally protected.
And term is so much cheaper than home. And the reason is because you can't borrow from term. Whole, your money you're putting into it. I mean, I don't want to say it's a bank account because it's not, but you're putting money into it that you could potentially get back and use before you die. Where term you can't.
It's definitely a fund, like, yeah, it's not a bank, it's not a bank account, but it's a fund and you should use it.
Investment.
Yeah.
Product. I thought this one was really good. I think the last one.
Yeah, what would these premiums be about on a whole life policy? Same profile.
We sure can do an exercise and quote if you'd like. But the last one, I thought was really interesting. So if you were to have had purchased what we were talking about, this one, the universal protected life, you can look at what the market did every year for the past 20 years. And what caught my eye was 2008, the market took almost a 40% dip. And yeah, you were at 0%, but you didn't lose anything.
So does that mean you didn't lose anything you put into it?
Correct.
Yeah, like, I don't know about you, but I'm like losing $30,000 every day on the stock market. Yeah, like I stopped. I look at my Robinhood account, like, shut up.
I mean, the same thing goes up if you look at the next year, 23% return, you're only getting 8. Okay, but like there's a good balance there, I feel like.
So I think that everyone probably wants to have one-on-one conversations with you.
Yeah, okay, so that is the other QR code somewhere in here. There's one if you just want to send me an email, and there's another one if you want to book an appointment.
Awesome.
Yes.
So if everybody had to leave here with one last nugget of information, Eric, we're gonna start with you. Like, if you could tell them one last thing that you wish you had mentioned already, like, here's your shot.
I love education and put an emphasis on that. So if you guys ever need anything, I talk to a ton of people every day knowing that they'll never take a loan out with us. And I genuinely enjoy that just because it's like, if you guys find the more you talk about the things you do, you kind of get better at it and practice it. So I have conversations every day with people that I know it's not a client or a customer, but I just enjoy educating them. And I've got term sheets sent to me from other lenders, from borrowers from other lenders where I say that's a much better product, you should go with that. Because I what's the point of lying to somebody and getting them to go with us? And so, so anytime people just want to talk about lending, because it's not often you're cued in on, hey, what are the rates right now? What would my monthly payment be? Just out of curiosity. I don't think of it as like a waste of time to talk to you guys. So I love educating people about lending because I do it every day, just as I learned so much from you today. So thank you. So I just know about lending, not much else. So anyone that wants to have a conversation.
I kind of agree. I don't ever look at talking about any of this, life, auto, home, whatever. It's never a waste of time. I really don't care what you do. I'm really only here to try and educate and benefit you. If you are at all remotely interested in working with me and doing what it is that I do, great. If not, I don't really care either. And I don't say that in a mean way. I don't know.
That's the Jersey in you.
Yeah, I don't want you wasting your time, and I don't want you to waste my time. Yeah, I guess that is me. And I found that interesting in moving here. You could take the kid out of New Jersey, but you can't take New Jersey out of here.
Yeah.
Yeah.
Well,
No.
and we went to University of South Carolina, so like we really don't have any excuse. The Jersey was taken out.
I'm looking at what point will it be that I've lived here longer than I've lived?
I'm almost
I'm
there.
getting there. Yeah. I'm not there yet, but it'll be soon.
I hope this was valuable. Awesome.
So we have his contact information in the packet. Do you have yours?
I halfway got here, realized I didn't bring any business cards, but I had a phone number and email, whatever is most helpful.
Yes.
Yeah. I'll do the number first. So my name's Eric, ERIK. Phone number is 610. That's Philadelphia.
I was gonna
Yeah.
say, Pennsylvania.
Yeah, 610-715-0086. And then the email address is just Eric, ERIK, at ifundcities.com.
Your email address is almost as fun as mine.
Yeah.
Be an opener of doors.
Check out our website. We've got some racy marketing on there.
That's fun. Love that. And if you guys haven't signed in, if you wouldn't mind, sign in. That way we can make sure that you get credit for being here.